Good evening, everyone. Thank you for joining us for our 18th annual webinar. I'm Oля Woychyshyn, and I have the privilege of serving as the CEO of Ivan Franko Homes, and I will be your host for today's session. Before we start our presentation, let me go over a few housekeeping items first. All participants will be on mute during the presentation to ensure a clear experience for everyone. If you have questions, please feel free to post them in the chat section on your screen. This session is scheduled to run for 1 hour, and each speaker will present for approximately 15 minutes, followed by Q&A session. We are thrilled to welcome you to today's webinar, Smart Tax Planning, Empowering You, Protecting Your Family, Strengthening Your Community. So let's get started. I'm honored to present our two esteemed speakers, Janine Kuzma, Associate Director of Gift Planning at St. Joseph Health Center Foundation. Janine is a fundraising professional with extensive expertise in legacy giving and gift planning. She has empowered countless individuals to align their philanthropic goals with effective strategies. And our second speaker is Lukash Woychyshyn, President of Monthly Capital Group. Lukash is CIRO licensed investment advisor with a robust background in quantitative portfolio management, tax and wealth advising, and estate planning. He brings a wealth of knowledge on minimizing tax burdens while maximizing impact. Both Janine and Lukash have personal connections to Ivan Franko Homes through family members who are residents here. Together, they will walk us through practical strategies that you can use today and in the future. At Ivan Franko Homes, our work is driven by compassion, community, and care for our seniors. As many of you know, we are in the exciting process of building the Center for Aging and Longevity, a state-of-the-art long-term care home where 160 seniors will find their home. This new home will be part of our future campus of care. Our dedicated team has meticulously incorporated each detail into the design to foster a modern, comfortable environment that is cozy and nourishing, allowing our residents to truly thrive. And we are preparing for the transition to our new home in the summer of 2026, next year. Our future campus of care will also include independent apartments and assisted living accommodations, and the vibrant central hub designed to bring together seniors and younger generations. This dynamic space will host health and wellness programs, cultural events, and educational workshops. This ambitious, thank you for the slides. No, just go to the next slide. Thank you. Yes, this ambitious project would not be possible without the incredible generosity and commitment of our community. The generous support of our donors has been the cornerstone of our efforts, and it is through their belief in our mission that we can bring this vision to life. I would like to take a moment to thank all of our donors and supporters. Your generosity, trust, and commitment make this vision possible. So thank you very much. Now, to help us dive deeper into today's topic, it's my pleasure to introduce our first speaker, Janine Kuzma, Associate Director of Gift Planning at St. Joseph Health Center Foundation. We are honored to have Janine with us this evening. She also serves as our fundraising consultant, guiding our team as we build meaningful connections between generosity and long-term community impact. Janine, welcome.
Thank you, Alu. And thank you all for joining us tonight. So the purpose of today's session is to explore how planning can protect your family and your estate. We want to inspire and empower you to think proactively about financial planning and charitable giving. And you will learn, hopefully, how philanthropy can reflect your values and create a lasting impact in your community. And you will be able to discover practical strategies to minimize your overall tax burden. Next slide, please. So why plan? You plan, and this is from the perspective of a fundraiser, from the lens of philanthropy. So why plan? It's for personal and financial benefits. It's for your peace of mind for today and for tomorrow, is to ensure that your wishes are honored and to create a lasting legacy and impact on your community. And also is to unlock financial and tax benefits through charitable giving. Those tax benefits can include reduced estate tax, income tax credits, avoid capital gain tax, increase flexibility and efficiency, and by smart planning, you might be able to bypass probate with gifts made outside of the will. And just for those who don't know, in Ontario, estates over $50,000 are subject to 1.5% probate tax, and then $15 for every $1,000 of the value. So when you don't plan, you might face a high cost for doing nothing. Next slide. So there are many flexible ways to give to a charity for today and for the future. You can be a monthly donor. You can donate a major gift, and this major gift can be made of a pledge. A pledge is a gift that you can spread over a few years, and your major gift and a pledge can offer you naming opportunity. So in a case of Ivan Franko, the naming opportunity, you can name a space or a program. You can also donate through your donor advice fund, family foundation. You can make a gift in honor or memory of somebody. You can donate your pension plans, such as RRSPs, RREFs, TFSA. You can donate life insurance, gift of securities, shares, flow-through shares, and you can make gifts in your bequest, and you can make planned gifts. Blend gifts, and those blend gifts are combined of current and future gifts for maximum flexibility and impact.
Sorry, Janine, I think you're on mute there.
Sorry. And now I want to talk about gifts in your will. Because I'm a specialist, I deal with wills, I deal with estate planning. So when you make a gift in your will, your estate receives 100% deduction for the gift's volume. So those gifts in your will can include a specific bequest, which is a particular amount. It can include percentage bequest, or you can put, for example, Ivan Franko in your will in case your loved one passed before you. The money will go to Ivan Franko. And you can also gift in your will a personal property or real estate. Next slide, please. There are many. You can also include your gifts outside of your will. and they are very cost effective with tax benefits. And those gifts outside of the will include registered retirement saving plans. And I think Lukash is going to talk about RSPs. The benefit to put them outside of your will is because they bypass probate and you get the full tax credit. You can also donate outside of your will life insurance. You can donate outside of your will gift of securities and charitable gift annuities or trust. Next slide. I think we're missing one slide. But I just want to mention, I mentioned Donor Advice Fund. And Donor Advice Fund, a lot of people are putting the money into Donors Advice Fund. And how do they work? You contribute assets such as cash or appreciated stocks to the Donor Advice Fund during your lifetime. And then you received an immediate tax deduction for the contribution. The funds are invested and grow tax-free. And then you can recommend a grant to your charity. You can also use the advice fund when you do your estate planning. And the way you do it, you can name the donor advice fund as a beneficiary in your will or retirement account, ensuring a charitable legacy that your family can manage for years. So to conclude my part of this session, the strategies to minimize taxes and maximize impact include making a cash donation, use life insurance, donating publicly traded shares, give through donor advice fund or family foundation, or include charitable gift in your will. So this is my part. Now over to you, Lukash.
Perfect. Thanks for that amazing presentation, Janine. And let me just share my screen quickly. Hopefully everyone can see it over here. Is everyone able to see my screen? Perfect. Okay, so, whoops, sorry, that's not what I want. Let's just get to the slide I want. Excellent. Okay, so thanks everyone for tuning in on this beautiful Thursday evening. I'm sure everyone's excited to finish this up and go outside and enjoy the rain. So I wanted to talk a bit about, I want to focus my presentation mainly on two sections. So some of this stuff, you might have seen already, but I'm going to break it down into mainly the types of accounts you can have, you as an individual, and then we'll get to everyone's favorite topic, which is obviously tax. There is a lot of material to cover. I'm going to try to condense it to 15 minutes or so, but again, with how complicated tax is in Canada, or how complicated tax can be in Canada, it's a lot to talk about. So hopefully some people have good Q&A, and I'll try to answer what I can. The majority of this presentation, I should clarify, will be focused on you as an individual. So we're not talking about if you have a corporation or anything more advanced like that. Specifically, what I want to focus in on is the value of tax planning, right? So there's a lot of benefits to tax planning. Obviously the first one is no one wants to be surprised come tax time in April that they owe a lot of money, but it helps a lot with peace of mind with planning, right? In order for you to effectively keep the most dollars in your pocket, and that's what we try to do for our clients, right? We want to squeeze the lemon as much as possible, so to speak. It's very important that you pay attention to your taxes, you pay attention to the accounts you have, and you structure things efficiently such that the CRA doesn't take more than the absolute minimum that they can from you, right? So let's start off with the accounts. And again, this is not meant to be a comprehensive list. There are numerous different types of accounts in Canada that you can. Oh, sorry. Did I freeze up? Can everyone hear me? Sorry, I'm not sure if anyone can hear me.
Yeah.
Okay, perfect. Sorry, I thought we froze up there. So let's talk about the accounts first and foremost, right? So, and again, forgive me if you've already seen this. Some of you might already know this, some of you might not. But again, I want to build things up from the ground level such that when we get to the tax portion of my presentation, it helps to kind of put things into perspective, right? So two types of accounts. broadly speaking in Canada, right? So there's non-registered accounts and there's registered accounts. And I'm going to go over a few of them. Again, not a comprehensive list. There are specific cases such as, an employer-funded pension plan, things might not necessarily pop up in my presentation that might apply to you, but this is in broad strokes the main types of accounts that you'll encounter in Canada. The easiest one to consider is what's called a non-registered account. So there's only one type of non-registered account. Sometimes it's called a checking account, savings account, a cash account. Those terms are used interchangeably, but basically it's an account that can hold some sort of asset that has maximum liquidity. And what I mean by that is an account you can take money out of, you can put money in of, you can put assets in of, and there's no restrictions on pulling money in, pulling money out. The downside of these accounts is that they are taxable at the highest level. So what I mean by that is if we jump to this page, there's a few different types of things you can hold in a registered or a non-registered account, excuse me, right? So you might be getting interest income, right? So that might be bonds, that might be GICs. You might be getting dividends. And again, a key thing about dividends is it depends who's paying them, right? It could be a Canadian company, or it could be an American company. It could be a European company, Japanese. It doesn't matter, right? But what does matter is the source of those dividends. And dividends from Canada are taxed in a more favorable manner than foreign dividends, right? So that's another consideration you have to think about. Capital gains, right? So this could be the sale of a house. This could be the sale of stocks. This could be the sale of bonds if they've appreciated in value. A lot of things kind of fall under that umbrella of capital gains. In general, this is the type of asset you want to hold, right? And the reason being is that only half of your gain is taxable. And I'm going to talk a little bit about this later on. And one more important point I should note is some of you are probably familiar. The Canadian government tried to introduce a higher, what's called an inclusion rate on capital gains last year, and that got shot down, thankfully. But they tried to raise the inclusion rate, which is how much of that gain is taxable, to about 66% on any amount over $250,000, right? Thankfully, they reverted that. We're back to 15%, which is good. But again, in general, you should be trying to take most of your income via capital gains because half of your gain is fully exempt from tax. So you don't pay a single penny in tax on half your gains. The other half is added to your marginal tax rate. Again, we'll talk about that later. Another way that you can get paid in a non-registered account is a return of capital. So this is some mutual funds will offer this feature where instead of paying you out a dividend, which is taxable, they will instead return part of your original investment, which is not taxable, right? And in this way, they basically pay you out kind of a pseudo dividend, so to speak, but you're not going to get taxed on it until you receive the full amount of your original investment back. And then you'll start to receive dividends in some way, shape, or form. So again, this is, you could spend hours talking about this and I'll try to condense it as much as I can. But in broad strokes, this is a non-registered account in a nutshell. Okay. Now we're going to move on to registered accounts. And again, there's, somewhere in the neighborhood of 8 to 10 different types of registered accounts. I'm going to cover the main ones. Right? Most of you will be familiar with this one, an RRSP, which is a registered savings plan. So this is an account that the Canadian government allows you to have to help supplement your retirement. Okay. I mean, if you think about it, normally retirement comes from one of three sources. It could be an employer pension or what you built up while working at your employer, whether that's in the public sector or in the private sector. You'll be getting a pension from the government. So that's kind of the second leg of your retirement. And then you'll also be getting government benefits, right? So that could be CPP, the Canadian Pension Plan, OAS, Old Age Security, GIS, the Guaranteed Income Supplement. And those are kind of the three pillars of retirement that we as Canadians really rely on when it comes time to retire. In a nutshell, okay, in an RSP, what happens is you contribute a certain amount every year, right? And that's up to you to contribute however much you want. There are limits, which I'll talk about in the next slide. Actually, I might as well just jump to this slide while I'm at it. So you can contribute up to 18% of your previous year's earned income. So let's say you made 100,000, you'd be able to contribute 18,000, right? 18% of that. However, there is a maximum limit. So if you're a high income earner, the maximum limit is $32,490. Again, this changes every year. The government will announce a new upper limit because again, if it didn't adjust for inflation, they'd be hurting Canadians. So the maximum you can contribute if your income is high enough to sustain it is 32,500, give or take. Okay, you can carry forward any room that you didn't use, right? So if you have extra room and you make more money in a future year, you are able to contribute more in that future year. All right, any amount that you contribute is deducted from your net income. So again, if I made $100,000 and I contribute $18,000. What that does is come tax time, I will receive a credit for the amount of the contribution. Okay, it'll reduce my net income. So I'm not being taxed on the amount of the contribution. Okay, eventually you are forced to pull money out of the RSP. We'll talk about that in a second, but it's a really good way to start building your wealth, sooner rather than later. Because what having that tax credit allows you to do is it lets the money in your RSP grow without having being taxed initially, right? So you have more money that can grow, and the end result of that will be a larger retirement account. Another thing you can do with RSPs is contribute to spousal RSP, right? So again, this is a little more involved, but in theory, if your spouse earns less than you, they have a lower tax rate, right? So what you can do is you can take advantage of your spouse's RSP room, put money in there, and they're effectively going to be taxed on it at a lower rate than you. Okay. Again, this is a little more technical, but something to consider. Um, in terms of contributing, this is something that often trips people up. You're actually allowed to contribute all the way up to February 28th in order to get that tax credit for the previous year. Okay, some people think it's December 31st. It's not. It's always February 28th. Fun fact, the reason the government does that is some people who are self-employed or contractors, they typically issue invoices, for 30 days after a service or good has been rendered, right? So the reason the government gives you an extra 2 months is for individuals like that might not be paid on the standard biweekly or monthly payment system. And then that way they can apply any sort of payments they have from, people that they rendered services to in December, let's say, when they get paid in January or February, they can apply those credits back. Obviously, if it's a leap year, the deadline is February 29th. So I know what some of you are thinking, but that's the rule. And then again, one more thing to note is you are penalized for over contributing to an RSP, and that penalty is 1% of the over contribution per month. So again, easy example, if you contribute, let's say $10,000 over your limit, you'll be assessed a penalty of $100 per month until you withdraw that amount. There is, technically speaking, a cushion. So if you contribute $2,000 or less over your maximum limit, you won't get penalized on that first $2,000. So sometimes what we tell clients to do is actually over contribute by 2,000. You might as well, because that money is going to grow tax free until you withdraw it. But again, that's more on the technical side. Now, the cousin or the brother or sister, if you want to call it that, of the RSP is the RIF. Okay. A RIF is what you do to your account when you turn 71. So all RRSPs have to be closed down by December 31st of the year in which you turn 71. All right. There's three options available to you when that happens. The first is you just take the full amount of the RSP in cash. Okay. So if your RSP is worth $200,000, let's say, you'll take that all as a payment in that year, and you'll be taxed on it, right? So generally, that's not advisable because your tax bill is going to be very high. I mean, if you're pulling 200 or 300 or over 1,000 per year, you're going to lose half of that to the government immediately. So it's not really worth it. The second option is to purchase an annuity, and generally speaking, these are kind of going the way of the dodo. Not a lot of people are doing them anymore, and there's a reason for it. Annuities give you a guaranteed amount per year, but the problem is if you die sooner than you think, the annuity might not pay your surviving spouse or your family out at all, right? So it's a good way you're basically gambling on you having a long life. And unfortunately, that isn't always the case. So what most people do, I would say upwards of 95% of people, is convert to what's called a RIF account, a registered income fund. What this account does is it's basically the same thing as an RRSP, except with one key difference. A RIF forces you to take out a certain amount of the account's value per year. Okay, there is what's called the prescribed rate, and I'll show you that over here. So depending on what your age is, you will be forced to take out a certain percentage of the account, right? So if you're 71, which is over here, you'll be forced to take out 5.28% of the account's value per year. Okay, so again, using a $100,000 account as an example, what will happen is $5,280 will have to be withdrawn every year. Now, this amount scales up all the way till you hit 95. If you live past that, which obviously I hope you do, I hope everyone does, you'll be forced to take out 20% of the account's value per year until you pass away. Now, you can also convert to a RIF before 71. There's no restriction on doing so. Again, it depends on your specific situation. There are advantages to doing so earlier in certain cases, but generally people tend to wait until 71 to convert. Okay, two sub components of these accounts is the home buyers plan and the lifelong learners plan. So again, if you're buying a house or you're studying, there are certain amounts that you can take up from your RSP early, right? Because normally when you put money in an RSP, you can't withdraw it without paying some upfront tax to the government. In these particular cases, if you're buying a home, a qualifying home, or you're going back to school for whatever the case might be, vocational, trade, doing a master's, whatever it might be, you can actually withdraw up to 60,000 per house or 20,000 in total for your education, as long as you pay it back over a certain period of time. I do have a slide in here about what are the benefits of early conversion. Again, I don't want to get too deep into this because it's going to take up the rest of your night. But in general, one reason that you might want to convert early is if you expect a lot of income. So again, if you're a high income earner or you've decided to retire from your job earlier than the standard 65, which is obviously changing with the times. Some people are working much later, some people are retiring earlier. So it might help to plan out your retirement if you consider having a RIF or converting to a RIF early. It'll give you a steady stream of income. One other thing is you'll be able to claim a pension tax credit. So you are able to get $2,000 of pension income, which the RIF is part of that. You can get $2,000 deducted off your end of year taxes, which for most people ends up being about $300 back in your pocket. Moving right along, a TFSA, tax-free savings account. This is the best account in my opinion. I think every Canadian should have one. There's no reason not to. Any gains you make in this account, whether it's through stocks and bonds, certain types of property can be put in here, certain types of commodities, so gold, silver can be put in here. Any gains you have on those, completely tax-free, right? The key thing to remember is you have a certain amount you can contribute every year. If you were 18 years or older in 2009 and you were a Canadian taxpayer, you would have automatically started accumulating room. So this does not depend on how much you make at work. Everyone gets the same amount. So if you were 18 years or older in 2009, you will have up to $102,000 of available contribution room, right? Again, if you over contribute, it's a 1% penalty per month. So keep that in mind if you're contributing to this account. Two more minor accounts before I get to the tax component. FHSAs are a new account. They were introduced in 2023, so two years back. This is kind of the best of both worlds, a TFSA and an RSP. In general, I'm assuming most people in this presentation have already purchased property. So most of us are not eligible for this account, unfortunately. I wish it was around earlier, but it's the way it goes. But your kids might be if you have them. So in this account, you can contribute up to $8,000 per year, which you see over here. Lifetime contribution limit of 40 grand. Okay. However, when you contribute, you get a tax credit back for your contribution. So that's kind of like an RRSP, and the growth of the account is completely tax free, right? So in theory, if you start contributing and you contribute the full amount every year, it'll take you 5 years to get that to that 40,000. However, that's a massive gain for you because it's effectively $40,000 that you've reduced from your taxable income, and all of that money will have hypothetically grown, right? So combine this with, let's say an RRSP that has the funds, you could conceivably pull out $100,000, completely tax-free to purchase or put as a down payment towards your house. Obviously, property in Toronto is a little more expensive than that, but again, if you're buying property elsewhere, or you combine it with a spouse's accounts, it could really add up and make purchasing a home much more affordable. Two more accounts are ESPs. Some of you are probably familiar with these. You would have set them up for your children. You can contribute up to $50,000 over the lifetime of the beneficiary, which in general could be your immediate children, but you can also do grandchildren. The government will give you a grant. Okay, they'll give you up to $7,200 over the lifetime of the account. Typically, it's $500 per year. It's 20% of your contribution. So if you contribute $2,500 a year, the government will match it. They'll give you $500 in grants every single year. Okay. You can use the payments from this account for anything related, even if it's vaguely related to a child's education. So sometimes, it's not just tuition, it's school books, maybe computers, residents if they're living, at any school. And again, these aren't just schools in Canada, any school globally that qualifies. So it can be college in Vietnam, it can be university in Ukraine, it can be whatever you want. You can pull money from this account. And the other benefit is, even though you don't get a tax credit for contributing, the money in this account grows tax-free, right? So if you set this account up as soon as your children are born, they have, let's say they go to school at 18, they have 18 years worth of tax-free growth. That really adds up. And the other thing is when the money leaves the account, all that growth is actually taxed in the hands of the child. Most kids don't make a lot of money when they go to school. I know I didn't. So it's good for you to funnel those contributions to your kids because their marginal tax rate, which we're going to talk about in a second, is very low compared to what you'll probably be making when you're, roughly mid-career for most people in this kind of time period. Last account, this is one that people probably might not have heard of. Some of you might have if you have family at Ivan Franko. Are DSPs, registered disability savings plans. So as long as you're eligible for the disability tax credit, which again is a little more technical, I'm sure some of you have experience with it, the government will actually give you up to $70,000 in grants and potentially $20,000 in bonds, depending on your income, as long as the beneficiary of the account has some sort of disability. You can contribute up to $200,000 per beneficiary. And this is an extra account that's supposed to help those that can't necessarily take care of themselves survive. Because some of you are probably familiar, government benefits for disabled individuals is not that great, right? Unfortunately, but it is what it is. And the RDSP is a good way to supplement, what are sometimes really high costs to take care of a loved one. So this is something, again, if anyone has any questions, feel free to ask about this, but a relatively unknown account. And again, you can put most things in your stocks, bonds, whatever the case might be. So really worth looking at. Now we're at the fun part of the presentation, tax strategies. So fun fact, Canada has one of the most complicated tax codes in the world. We often joke with our clients, no one, me included, fully understands Canada's tax code. I mean, most people tend to be specialists in one area or another, but the Income Tax Act, which is what governs tax in Canada, is 3,000 pages long. Then there's 2,000 pages of regulations. Then there's bulletins, guidance for niche cases, 5,000 to 6,000 pages on top of that. You're looking at over 10,000 pages in complex legalese, writing that, quite frankly, no one understands, or you have to look it up when a client asks you a question. So I'm not going to, say that this list is exhaustive. I just want to give you a few basic strategies that you might find helpful. And again, if there's any specific questions, feel free to bring up in Q&A. But before we get into everything, one misconception which I absolutely hate hearing is people will say, "Oh, if I make more money, I'm going to pay more tax." That is true, as you can see from this graph, but it's only true to the extent of the tax bracket you fall in. So Canada has these buckets, right? Let's call them that. Depending on how much money you earn, and this is, by the way, a combination of federal tax and Ontario tax, okay? So these are the most recent tax brackets. Depending on how much money you earn, you are taxed a certain percent. But let's say, you make 50,000 and then all of a sudden you get a raise to 55,000. You might think I'm paying, now I'm paying all of a sudden 24% on my income versus 20%. That's not true. You're only paying the higher tax rate on every dollar you earn above the bucket you're already in. So making more money, paying tax, I don't think anyone particularly enjoys it. I know I don't. But it's never a bad thing to be paying more tax because what that really means is you're making more money. So keep that in the back of your head. The highest bucket that you could be in is if you make over $246,000, you'll be paying more than half of your income to the government. So what can we do to reduce that, right? That's kind of the name of the game here. Few strategies that I kind of want to touch on. And again, there's a lot of ways that you can legally, but I want to focus in on that word, legally reduce your tax burden, right? This isn't meant to encourage any sort of tax evasion. It's just meant to take advantage of the system that has been created for you. And unfortunately, not enough people know about some ways that they can reduce their tax burden. One of those ways, and the most easy to understand, is you want to be taking your income in capital gains if possible, right? So like I said at the beginning of the presentation, only half of your gain, whatever the amount might be, is included in your taxable income. So if I sell something for 100,000, let's say condo, again, not really realistic in today's market, but let's say, rewind the clock 30, 40 years, that might be the case. Only half of that is going to be added to your tax income, right? So only $50,000 goes to your income for the year, and then you're taxed at whatever bucket you happen to be in. One thing you should take advantage of is if you have a year where you're earning less for whatever reason, let's say you just retired and you're no longer pulling a salary, that's when you want to be selling assets, right? Because your overall income is lower, so you're paying less on that incremental income, right? Another thing you can do is you can offset any capital gains with losses. So if you have something in your stock portfolio that isn't doing well, you have property that's fallen in value, You can offset the gains you have with losses, and losses are 100% tax credits, right? You can carry those losses forward indefinitely. So let's say I've had a bad year, I've lost $10,000 in the stock market. If I don't have any capital gains to offset, I can keep that tax credit and I'll use it in a future year if I need to. Another interesting thing is you can actually carry those losses back 3 years. So if I've had a really good year, let's say a year back, but I had a bad year this year, I can actually refile my taxes because it was only 1 year ago and use that tax credit against last year's income. So that's really useful. Semi-related to this is timing the sale of your assets. So again, if I need, a bunch of money, and I have $100,000 gain, and this is actually a good time of year to talk about this, right? So why would I, if I can help it, I'm not going to sell all of that in this year. Maybe I'll split it up, $50,000 now, November or December, and then I'll sell the remaining 50,000 in January, February, because those are two different tax years. What I'm doing now is I'm splitting up my income, and I'm trying to avoid being pushed into the highest bucket possible, right? So that's something also remember when you're selling. You cannot buy an asset and sell an asset within 30 days of a transaction because that's called a wash sale or a superficial sale. So the government frowns really heavily on that. Generally speaking, if you buy something, hold on to it for a month before you sell it, right? That's just good practice. Otherwise, you are going to be taxed on the full amount of the gain. And the losses they might not be allowed, right? Because what the government thinks you're doing is trying to cheat them by like buying something and then selling it right away to try to claim a capital loss. So be very careful with that. Gifts, this is important, and Janine talked about this a little bit earlier, but gifts are a good way of reducing your overall tax burden. Now you have to be careful here because if you are obviously trying to cheat the CRA out of what they think they're owed, they will come after you, right? That's called an attribution. So they're very strict about what you can give to friends, family, so on and so forth. One example of this is, let's say I make a lot of money, I have a big investment portfolio, and I have a few kids. I'll say, here, kids, take the portfolio, right? Because kids aren't taxed on virtually anything. But the CRA will come and say, no, you're trying to offset your gains to your kids, and all of those gains will be attributed back to you, and they'll hit you with the penalty. So you have to be very, very careful with doing this. You typically can gift to adult children, so anyone over the age of 18, but generally speaking, and again, this is where that 10,000-page tax code goes in. Generally speaking, do not gift to a spouse. Do not gift to underage children. So adult children, okay. Spouses, underage children, no go. You can give your spouse a loan. However, if I have a lot of money, right, my spouse, let's say they earn less than me, I can actually loan them instead of gifting something to them. I can loan them my investment portfolio. I can loan them cash because if my spouse earns less money than me, right, I'll loan them some sort of asset. And then what they have to do is pay me a prescribed rate of interest. So the CRA quarterly publishes the prescribed rate. Right now it's 3%. It actually was at 5% earlier this year. So it's actually good. It's come down. But one way to think of this is if I loan my spouse $100,000 or $100,000 in stock, they can keep it in their name and they just have to pay me the interest back. So 3% per year, $3,000. But then what happens is the gains are taxed to my spouse, not to me if I'm making a lot of income, right? So that's one thing you have to kind of think about, and spouses are very helpful from a tax planning perspective. Sometimes, it's really to your advantage if you have a spouse that's staying home, taking care of the kids, or, you might be making a lot of money, they're not. It's a very powerful way to kind of deal with your tax burden to incorporate them in some way, shape, or form. Again, keep good documentation. That's what we always tell clients, because if an audit happens, and you can bet an audit's going to happen one day, you want to have everything airtight. You want to have good paperwork. You want to say, here's why I did X, Y, Z. Again, typically you'll have an accountant helping you with this, but another strategy kind of keep in mind. Charitable giving. So this is Janine's favorite topic. So let's talk about it. You probably know that if you donate cash to a charity, you will get some sort of tax credit back. But what you might not have thought about is you can actually gift your assets as well, right? So it could be stocks, could be metals, could be bonds, whatever the charity will take, quite frankly. It could be artwork. Some charities will take that. Janine once told me a funny story of someone donating a grand piano. Again, I don't know what they did with it, but there you go. So what happens when you donate an asset is actually quite interesting. What'll happen is when you gift something, and I have an example here. So if you have a stock, you purchased it for $10,000 worth of stock, let's say Apple stock. It's gone up in value, it's worth 20,000 now. What'll happen is you will actually get a credit based on the full amount of the donation, right? So that's really powerful because the other thing you can do with stock, if you think about it, you really only have two choices if you want to donate it. One is you donate it directly, right? And you'll get a full tax credit for that. But the second option is what if I sell it, right? And then I just give the charity the cash. Now, you might think that those two are equal, but they're actually not. And we have an example here. So if you sell, and we're using an example of, you bought shares, whatever they might be, for $600, you sold, and now they're worth $1,000. They've gone up in value over the past, let's say, 10 years. If you sell them, you will have a gain of $400, right? The difference between 1,000 and 600. Now, the government will tax you on that in the form of a capital gain. And here I'm assuming that you're at the highest tax bracket. So the tax on your gain would have been $107. Once you paid the government, you only actually have $893 to give. So the charity only gets $893, and then you'll get a credit of about 50% of that, which is $450. So the charity gets less, and you actually get less compared to this. If you just donate the shares directly, you'll get the full credit, right? And the charity will also get $1,000 worth of property, right? As opposed to getting less if you just gave them the straight cash. What the charity does with that asset is, again, entirely up to them. Sometimes you might have an arrangement with them that's dependent on the charity, but it's not your problem once you've given in most cases, right? And your tax credit at the end of the day actually ends up being higher than had you sold the shares. Any sort of tax credit you get here is actually, you can carry it forward up to 5 years. So, again, if you're nearing the end of your career, you're earning a lot of money, you have a significant investment portfolio, it's actually a really good way to kind of offset your tax burden going into retirement. So very, very powerful way to take advantage of the tax code. Last thing I really want to talk about is life insurance. Again, two things you can do with life insurance. You can either give ownership to the charity now, right? So basically what you're saying is take my life insurance policy. I will keep paying it, right? The monthly premiums, the monthly payment on the policy. And what I'll get is I will immediately get a tax receipt for the fair market value of the property. So let's say I have $100,000 on my life. I'll get a credit for that. And I will also get any sort of premiums I continue to pay to keep the policy active. Right? You can actually use these credits to offset up to 75% of your net income. And again, there's a 5-year carry forward on this. But this could be huge if you want to basically get not taxed for a few years. So really, really powerful way to get some of your money back. Here I have an example. You have a policy worth $50,000. You give it to the charity. You're going to get a tax credit for about 50% of the surrender value because this is the donor tax credit, and you'll get the premiums that you're paying to maintain the policy. Option two with a life insurance is you just name the charity as a beneficiary, right? So you still own the policy. You can decide what you want to do with it. However, you are not going to realize any sort of tax benefits while you're still alive. When you pass, your estate is going to get the tax credit. So again, depending on your specific situation, you have to kind of consider whether it's better to transfer the ownership of the policy now or name the charity as a beneficiary. Over here, I have a brief chart, again, that kind of shows the difference between the two of them. Depending on what you want to do with the policy, it might make more sense for you to maintain it. But at the end of the day, what matters is you want to minimize your tax burden. So if you want to minimize your tax burden now, typically you'll transfer ownership. If you want to name the charity as a beneficiary, you won't get that tax relief, but your estate will. So, a few kind of important points there is, again, the benefit to you from a tax planning perspective can be huge because policies typically have a lot of market value. Most people take out decent size life insurance policies. So you can get a really big tax credit up front. You're guaranteed to get a tax credit. That's the other thing, because obviously if you have an investment portfolio, it might go up 1 year, down 1 year. This way you kind of lock in the tax credit you're going to get. And then again, you don't necessarily need to, if you want to maintain anonymity, which for some people is a consideration, that's one benefit of using life insurance to donate to a charity, right? So you can keep it totally off the record. It's just an arrangement between you and the charity. You don't necessarily have to announce it. No one needs to know except for you, the charity, and the CRA, obviously, because they need to know everything. But that's kind of a brief primer on life insurance. And again, like I was saying, there's plenty of methods over and above the 5 or 6 strategies I just presented. But just kind of food for thought, just to kind of get you thinking. And again, obviously, if there's any kind of questions, and I'm happy to take them on the tax planning perspective. But that about wraps up everything I had to talk about. So right now, I'm going to give the presentation back, and we can go from there. All right, thanks, everyone.
So, so can
Thank you,
you leave
Lukash.
our
Uh,
contact?
we do, yeah, even anyone would like to contact you, they can call our office and we'll connect with Janine or with Lukash. Lukash, could you please take a look at our Q&A section? There are a few questions, I believe they are for you.
So can
Not
I go with the first one because I see it's
Yes,
about the
please. Yes.
but before I go to the questions, I want to add Lukash was talking about life insurance. So this is actually a great way to use a little money for a big donation. And all I was mentioning, and I was mentioning the naming opportunity. So we, for example, in the hospital, we have a person who donated $1 million life insurance. He is about 50 years old. He's paying very little monthly, but he's recognized for that $1 million as a major donor. So that's my 2 cents about life insurance. But now about the questions. So what are the most common misconceptions or myths about legacy giving? So I think that the most misconceptions are people are thinking that if I make a gift in my will, I will take money away from my loved ones. But it's actually not true because you are when you donate money to a charity in your will or outside of the will, you are minimizing the tax payment on your estate. A lot of people also are thinking, I don't have enough assets to actually make a legacy gift. But today, your home probably is worth $1 million. You have another RSP. So when you combine this together, your assets are quite high. So you should be trying to reduce the tax on those assets. Lukash, do you want to?
Thank you, Janine. We have 11 more minutes. So, Lukash, could you please answer
Sure.
the second question?
I can't actually see the questions. Should I give you guys control of the screen back?
So I can read the question. I have $1 million in RSPs and some amount in non-registered accounts. And no significant capital gains in my assets. If I want to leave $1 million to charity like Ivan Franko Homes, is it better to designate to it RSP's beneficiary or a beneficiary under my will? So if you don't want to, are you good
Well,
with that?
yeah. I mean, the issue with having a significant RSP if you were to pass is when you pass, the government will try to assess tax on the fair market value of that RSP. So let's say that you unfortunately are to pass tomorrow, your estate basically has to foot $1 million tax bill or whatever the gains might be. You'll be taken as income, right? So we want to avoid doing that. One way I should say before I get to the beneficiary issue, because regardless of who you designate as the beneficiary, whether it's your estate or the charity, the government will try to get their share of it, right? So you're not really going to be able to avoid giving the charity the full amount of the RRSP by just designating them as the beneficiary. It wouldn't work that way. You might be able to give your estate a credit if you designate the charity as a beneficiary, right? So if there's something that you want to pass on to next of kin, if you have them, or kind of split up the value of your estate, that is one thing that you can consider because you'll get a tax credit back. So you should, if that's your objective, you should designate the charity as a beneficiary. One thing I didn't really touch on earlier is the way that a lot of people tend to offset a big tax bill when they pass, because you have to consider, a lot of your assets, it's not just assets that you have in investable accounts. It could be property. That's another thing. If you have, a cottage or a secondary residence, when you pass, all of that is going to be taxable to your estate, unfortunately. The only thing you can pass on without incurring capital gains is your primary residence. And what happens there is it's called a step up basis. So the fair market value of that property will be adjusted up to whatever, the current market value of the house is, and you can give that to next of kin. But with respect to your RSP, one thing that people tend to do is buy a life insurance policy, and they'll use that as a charitable gift to, the charity or whatever cause you're passionate about, and that will actually offset the amount of income that your estate gets from your RSP when you pass. So that's one thing you can do. And if you don't want to consider buying life insurance, for whatever reason, it might be really expensive at your age, whatever that might be. Yes, you can designate the charity as a beneficiary, and that will go further in terms of maximizing the value of your gift versus you designating your estate as the beneficiary or a next of kin.
Yeah. I think the next question is also for you. What are
I
some of
can
the
read,
most,
Janine, I can read the
yeah,
question.
sorry.
Thank you. So the next question would be, what are some of the most overlooked tax saving opportunities at the year end?
Well, at year end, again, one thing that I always kind of tell clients is you want to review all of your investment accounts and see what has done poorly. The analogy I like to use is think of your investments as kind of a garden, right? People often what they'll do, and this is just a psychological thing that we all humans have, they'll tend to if they see something's losing from an investment standpoint, they don't want to sell it, right? Because what you're doing psychologically is you're crystallizing the loss, right? You're making it real. Because if you haven't sold something, in the back of your head, there's always that little voice that says, what if it comes back? What if the value rises and I make my money back? But that's actually the wrong way to look at it because, again, going back to the garden analogy, that's like if you went into your garden and you, instead of, watering your flowers and pulling out the weeds, you're actually watering the weeds, you're keeping underperforming investments in your portfolio, and you're cutting flowers. You'll tend to sell winners, right? So one thing that people should always do at the end of the year, review your investment accounts, see what's doing poorly, get rid of it. Honestly, that's the best advice. I know, again, psychologically it's painful, but if you do that, you're going to start to stack capital losses that then you can offset future years with. So that's one big thing that you can do. Again, another thing is, some people tend to get bonuses from work right around Christmas time. If you want to get a tax credit back, see if you have any room in your registered accounts, right? RSP, RESP to try to get some government grant out of it. Obviously, if you have kids, if you don't have kids, you don't have an RESP. So review your accounts, make sure that there's nowhere else you can put it, and again, donate. Right, if you're feeling generous, donate to a charity, Ivan Franko, or somewhere else that you're passionate about, because otherwise you're just giving the government money. And I think most people would be more, as sometimes it's painful to give away money, but at least it's going to a cause that you're passionate about, rather than you giving it to the government to spend on things that you might not necessarily care about. So that's one thing I always kind of try to tell clients to focus in on.
Yeah. So the next question is, can an RDSP be used to help fund long-term care costs for an older loved one?
Yes, yeah, absolutely. So our DSPs are pretty flexible for purposes like that. And again, one thing, and again, I don't want to take up too much of everyone's time, but because I'd be here literally all night, we'd be talking till tomorrow. But there's a lot of credits out there that people aren't aware
Six
exist.
more minutes.
Yeah. So the RDSP, a good way to kind of maximize use of that is yes, you can use it to help fund living expenses, mobility expenses for people in long-term care homes. And oftentimes you'll find that you can combine whatever profits or money you pull out of that plan with existing credits that the government has already designed to support people with disabilities or seniors needing assisted care. So yes, you can.
Yeah. The next question, what do you, our speaker, think of reverse mortgages as a form of financial planning?
Uh, so the that is it's a complicated answer and it depends on your situation. One thing that reverse mortgage, so there's something called the Smith maneuver, which is more technical, but here in Canada, we cannot deduct the baseline rule is you cannot deduct mortgage interest from your income. In the States, you can, which is one advantage they have over us. However, if you do a reverse mortgage or a HELOC, and then a home equity line of credit, for those that don't know what a HELOC is, you can actually deduct the interest component that you're paying back to the bank As long as you use the cash that you got out of it for the purposes of investment, and that can be very flexible. So that can be, again, stocks and bonds, that can be other property, but as long as you're using that money that you borrowed out of your residence or whatever property you own, it's good from a planning perspective, because as long as you're kind of diligent enough to use that money for investment purposes, that's when the interest becomes deductible. So, again, if you're interested in this, give me a call or look up what's called the Smith maneuver. It's a tricky thing to understand at first, but there's definitely a place for reverse mortgages in terms of a financial plan. But you also have to remember that if your investments go south for whatever reason, you're on the hook for your mortgage still, right? So you have to be able to stomach that kind of risk. And for certain individuals, it makes sense. For others that don't necessarily want to take on a lot of risk, there might be better options available to you.
Thank you, Lukash. So the next question is, how do you start using TFSA or RRSP? I'm 37-year-old now.
Yeah, so you can open a TFSA anywhere, us included. That's a little self plug, but the just go to whatever institution you bank with and ask them to open a TFSA. One thing you should be mindful of is people think when you open a TFSA, it just automatically starts to grow. No, that's not the case, right? Obviously, you contribute to it every year as much as you can, would be my recommendation. But the real value of a TFSA is if you use the money in a TFSA to invest, right? So sometimes you might have what's called a self-directed TFSA, which is you decide what the investments go into. Or if you don't want to bother, again, you can go to your bank or have a portfolio manager manage it for you, right? And then they will pick the investments that go into the TFSA, and that's where you get the real value, right? Because if you're just putting money into a TFSA and not doing anything with it, you might as well just put money into a checking account. There's no real benefit there. The benefit is if you invest it and you start to grow that money. But it's very easy to set up. It's not something you should be intimidated by. Just go to your bank or talk to a financial advisor, and they will help you set one up.
Thank you. The next question would be addressed to Janine. What role do naming opportunities play in legacy giving, and how do they work?
What role do naming? So in legacy giving, actually, so when you talk about, let's say, gift in your will, and you let the organization know, let's say, you giving $500,000 or $100,000 to Ivan Franko, you let them know, and they have naming opportunity for X amount of money. They can name it, but you have to have a gift agreement and let them know, and they will use the naming opportunity. And each organization, when you give the money right now, for example, major gift or pledges, they also go under naming opportunity. And each organization, they have the specific amounts for specific places or specific projects. So it's up to the organization, and they will let you know what the naming opportunity is for X amount of money.
Thank you, Janine. And the last question, like we have 1 minute left. Is church considered charity in Canada, and what CRA rules applies to tax such donations?
Yeah, so church, it depends on the church, because the reality is anyone can set up a church. I mean, you can set up your own church, the Church of Pasta, if you want. The important thing you do is you have to ask the church if they're a registered charity. So if they are, the way you know is that they'll give you their tax number. It's typically RR, it starts with RR, and then there'll be a bunch of numbers behind it. So you have to ask them for that number. If they do have a number, you can go onto the CRA website, type in their charity number. If it pops up, then yes, you'll know it's a registered charity. So be very selective about giving to churches, because not all of them have registered as charities. Most have, but not all of them have. So be very careful with that. And then the CRA rules with respect to donating to churches are the same as any charity. All charities, there is no kind of tiered system of charities, right? So no charity gets preferred tax rules over another. Again, you'll get the donor tax credit based on the value of your gift. Generally, it's about 50% of your gift, and you can use that to offset your taxable burden, or up to 75% of your taxable burden per year. So that's the one thing. Just be careful about who you donate to, because some people say that charities when they're not. Again, from our perspective, it might be charitable. I'm giving money away, but if you're trying to get tax credits, you have to make sure that the government has registered them as a charity.
Thank you very much. Thank you all for joining us today. And a special thank you to our speakers, Janine and Lukash, for sharing your time and expertise. I would like to sincerely thank to all of our supporters again for your continued support of Ivan Franko Homes. And if you would like to make a difference, please visit our website and see how you can support our cause. Last comment that you will receive a short survey to share your feedback and ideas for future webinars topic. We value your input and look forward to staying connected. Have a lovely evening, everyone. Thank you very much.